Hey everyone, me Kevin here. The S&P 500 has eradicated all of its 2021 gains, just like ARK Invest, which is down over 25% from its peak. Unfortunately, now the market is continuing to get battered. Futures are down. The Chinese stock market has opened down. We have after hours not looking pretty. We had a pretty dang big sell-off today, and now we got 16% of a loss at Super League Gaming. We got Agora down 6%, the backbone behind Clubhouse. We got Sens down, CCIV down another 5.5%, under $23. Pinterest, Lemonade, Vroom, Neo, Tesla, you name it. Tesla's sitting at $600 a share. What's the market gonna open like tomorrow? We have absolutely no idea, but in this video, we're gonna talk about, will this crash keep going? What is causing this madness? And what do I think about it? When do I think it's going to end? What's it gonna take? Let's talk. So first, let's give a shout out here to our boy Jim Cramer. Jim Cramer on CNBC thinks that the market is flooded with investment opportunities. He mentions SPACs, he mentions big IPOs coming like Coinbase and Roblox, plus there are shareholder lockup expirations at newly IPO'd and newly SPAC merged companies that could potentially lead to a massive glut of stocks available on the market for purchase. And as we know, when supply goes up, price goes down. And this is why Jim Cramer believes that the market might have further to fall. On top of what Jim Cramer said, you also have the crypto craze. Do you pick Bitcoin, Ethereum, Cardano? Do you pick all of them? Do you put a little bit into all of them? Do you put money into NFTs? Do you put money into real estate? There are literally so many freaking endless opportunities right now that it's not just what Jim said, but it's all of the opportunities combined right now that kind of start making us feel like, oh crap, we're kind of running out of money. In fact, I just ran a poll on Twitter, which if you don't yet follow me on Twitter. You can follow me at RealMeatKevin, and in the first 35 minutes of the poll, 3,700 of you voted, and 58% of you have said, I'm out of money. 6% of you said that you're selling stocks and not buying, so the most of you are diamond handing this. And 36% of you said you have money left over to invest. So only about a third of you actually have money to invest right now. Now, let me be clear. I am aware that the vast majority of us following me certainly are probably retail investors, which kind of supports this narrative that, yeah, we're kind of running out of opportunities here because we have too many opportunities but not enough cash, which is a problem. That makes it hard for us to prop up the market by buying the dip. So what then can turn this market around? Well, in my opinion, it's actually what's causing this market to fall, and that is institutional investors. I personally think institutional investors are doing what they deem to be safe bets right now. I personally believe it's institutional investors, the big hedge funds, the big money managers, that are trying to protect their clients and their pension funds and their whatever, health insurance companies or whatever it is that they represent, their municipalities or whatever. And they're trying to protect their clients. And they're saying, you know, tech's overvalued. Tech is passé. We're in a tech wreck right now. Let's invest your money into a diversified portfolio of the John Deere and the Home Depot, and let's throw some Disney in as well. And how about some Carnival Cruise Line? They'll pay off their debt. They'll be okay. We're going to have a travel boom. Don't you want to go traveling after this pandemic where you've been locked up for over a year? Yeah, we'll invest into those things because that's where it's at. Personally, that's literally what I think is happening. I think institutional money is literally flowing out of tech and energy and some of these SPACs and going directly into recovery, although we're also seeing those stocks sell off a bit. So sure, while we might be seeing 15% declines in like a tech, and we see, you know, maybe modest declines or stability at Disney, Disney's still modestly declining, we see that as well. A lot of the money seems to be flowing over there. Some of the money is obviously getting caught up somewhere. Probably some of that money is getting caught up in shorts and puts, which are actually, in my opinion, artificially accelerating this decline as hedge funds gotta hedge because we don't want our clients to leave, because we don't want our clients to think we're just doing the Cathy Wood and buying the dip. We want our clients to feel like they're protected by every complicated hedge option that exists, so we're gonna short this market. Yes, that is, after all, what funds do. So what's the point? Well, the point is, I don't think retail investors are screwing the market right now. This is not retail investors selling. This is institutional investors seeing the start to a tiny transition, and now they're like, maybe rates going up, inflation happening, move away from the high value, let's go away from tech, and sheep on over to recovery plays, cash, shorts, puts, maybe some bonds. Maybe some of them are throwing money into Bitcoin, which could explain why Bitcoin has actually been relatively stable through some of the madness here. And that is relatively stable. I know Bitcoin is volatile, but surprisingly, it's been holding up relative to like tech stocks, right? Personally, that's what I think is happening. And what's fascinating, if this is true, is I would not be shocked to see that very soon, especially where these prices are heading, very soon, these institutional funds are all going to have moved over, and then they're going to go, wait a minute. Tesla looks pretty damn cheap right now. In fact, Cathie Wood just put out a new bullish statement on Tesla, which she hasn't yet. I'm projecting into the future, which she plans to do soon. She put out a new bullish research statement on Tesla, and she's right. Tesla is actually a value play. Why would we buy these indebted companies in dying industries when we can buy the next frontier at now a cheaper price? Hey, let's move back over. And then slowly we get that rotation back. We get people closing their short positions, which have been going up at a lot of companies. We get people selling off on their puts. We get people then taking money, these funds taking money, throwing them and rotating them right back into the Tesla, the Pinterest, the Etsy, the EXPI, and whatever. Possibly also consolidating other funds they have available, the cash they held, or bonds they bought. Who knows? Maybe bonds go back up, and then they take the cash they invested in the bonds, throw that right back into these stocks, and we end up seeing a pretty instantaneous boom back. And this boom back is exactly what I want to basically prevent buying after. That is, I believe, simplifying my explanation here, I believe we are going to see a big rotation back into tech and the future of America. EXPI, Tesla, Apple, Google, Amazon, these companies are the future of America. The Matterports of the world, the CCIVs, the genomics, the trade desks, the NEOs, the open doors. These are the future companies of America, and money will flow back to these. The problem is when. When are those values going to, or those prices going to get to the point where the institutional investors say, let's close our shorts and let's get back over into the tech play. Let's get back into that space. When that happens, it'll probably happen pretty fast. It won't take many institutions doing this, and it'll happen pretty fast. When that happens, I would expect the market to bounce back pretty dang quickly. And this is why I've been driving so many of you nuts with all of my stock buy alerts, because I am not selling this dip, I am buying this dip. I broke down my margin, I broke down my entire strategy with all the course members today in the Stocks and Psychology and Money group. In fact, many of you have been sending messages in the chat going, hey, talk to my CPA, they confirmed I can write off your stock course. So that really means instead of paying like $400 for your course, I'm getting it for like $275, some of you were saying, which is really awesome because of the tax benefits. Obviously, check with your CPA. But yeah, I mean, check out the program. Link down below. It's a 38% off coupon. It does expire in less than 2 weeks, which means the current price will go away. So do check that out. That coupon does expire. It's linked down below. But the big question now is, when will this rotation happen? What catalysts are going to lead this rotation to actually happen and take place? Let's talk about that. The first potential big catalyst that can push everybody right back into tech is understanding what's going on at the Fed. First of all, I saw multiple videos today from multiple different creators, and I'm not trying to bag on anybody. Maybe I just have a different perspective, but there are multiple people saying that, and even CNBC, oh my God, CNBC had an article that's like, the market is just spooked because Jerome Powell said inflation is coming. No. Wrong. That is not what Jerome Powell said. Jerome Powell said inflation is coming temporarily, but it will not stay here. If you want a further explanation on what's going on at the Fed, please type this in the YouTube, write this down on your notes or your phone right now to look this up afterwards, okay? Or open up a new tab. Meet Kevin, why the Fed just crashed the market. You need to watch that after this. But first, listen to these other catalysts, okay? I'll remind you again on this. So, Watch that for what's actually going on. It's very interesting. You got to understand that. When this expectation of inflation coming ends, and when the suits start realizing, wait a minute, maybe inflation isn't coming, then our favorite stocks go right back to the moon. That is one of the big catalysts. However, that's going to take a while. It's probably going to take, in my opinion, 3 to 6 months for the suits to realize inflation isn't coming the way they expect. That means for the next 3 to 6 months, they could be right with this fear that inflation is coming, which is bad. That means we need a sooner catalyst. Okay, well, what's another catalyst? Well, more pain happens, the bond market continues to sell off, leading yields to go up, and maybe finally the Fed does what we were expecting the Fed to do today, and they swoop in and extend bank capital reserve exemptions. Now, this is a fancy way of basically saying the Fed waves their magic wand, lets banks have or spend more of their money on whatever they want, like bonds or purchases. Basically, they need to keep less sitting around in cash doing nothing. If the Fed says you're good to do that for longer, another 6 months or a year, then banks could, in theory, go buy bonds, and maybe those yields will come down as bond prices go up, and the market will be happy again. So in other words, bottom line of this last 30 seconds, the Fed could literally wave a magic wand, not print more money, and potentially solve the velocity of this bond market freaking out. And I think we'll have a rotation like that. I think we will have a very fast rotation. Waiting for the inflation not to come is going to be very painful, and it's going to take a while, and Bitcoin could go to the moon between now and then. This is why it's probably a good idea to own at least some Bitcoin, which is one of the reasons I have a Bitcoin over at BlockFi, where you can get up to $250 for free if you sign up and purchase Bitcoin and get interest on your Bitcoin, which is great. They're paying like 6% on your Bitcoin right now. And you can go to metkevin.com/BF, BlockFi, metkevin.com/BF to sign up for an account over at BlockFi. But anyway, that is going to be the quick catalyst. So slow catalyst, inflation doesn't end up coming the way we expect, and Jerome Powell's right. That's the slow catalyst. That doesn't have to be the right one, but that's the slow one if that happens. The quick catalyst is the Fed going, bloom, hey bank, go ahead, spend money. And I think the market will react very positively today, and I think that's why we had a double dip crash today, because that did not happen. The market was hoping that would happen, but it didn't happen. And so that's why the market started selling off more, when it became abundantly clear that the Fed wasn't going to do this. Watch that video. Meet Kevin. Why the Fed crashed the market today. Much more detailed explanation. So, the Fed could act sooner. That would help. But if the Fed doesn't act, what else do we have? Well, we have tomorrow's job report, but honestly, that's probably going to fall flat. Okay, cool. So the unemployment rate goes down. But what does the unemployment rate signal to old school institutional investors? Well, old school institutional investors go, well, when the unemployment rate goes down, that means jobs become more competitive and the price of labor goes up, which means inflation goes up. So thank you for reiterating my argument. Inflation's going to go up. That is entirely possible. If the unemployment rate goes down, which we expect it will, then we could see more pain because people are like, that's it, inflation is coming. Now, this hasn't actually been true. And this is why this is also complicated, because old school economics says unemployment rate down, inflation up. Well, the last 10 years, unemployment rate be falling and inflation be falling. It's literally everything is turned topsy-turvy. Everything is freaking nuts and confusing, and that's why there's so much happening in the market right now. Because nobody has a clear picture or understanding of what the HE double hockey sticks is going on, with the exception of me. I'm just kidding. I'm probably the last person that has any clue as to what's going on, because here I am again, wearing the Tree of Life Druid shirt, which you can barely see from World of Warcraft. So, take note of who you're taking advice from here. So, convincing the market that inflation is not coming. Slow play, bad. Not a good catalyst, okay? The Fed waving their wand and changing liquidity requirements, good catalyst. The unemployment rate going down, probably a bad or neutral catalyst. Like, it's not going to help us. This means this dip could continue. How long? Historically, these dips last 6 weeks. We started this back on February 19th. That means February 19th through the end of March could potentially be a nasty period of time to invest. A lot of pain, a lot of loss, a lot of paper handlers selling because they can't take it anymore, or stop losses getting triggered because they went in as diamond handlers, but they were secretly paper handlers. I'm not trying to offend anybody who has stop losses, okay? Stop losses totally have their purpose. I'm getting a little extreme here. But what happens between February 19th and the end of March? The stimulus package. Is it possible that when the $1.9 trillion stimulus package passes, which I believe has a very high likelihood of actually occurring, is it possible that that stimulus package props the market back up? Potentially. Because right now I believe the market is pricing in $1.9 trillion of money printing because there's already been so much money printing. Like, the inflation fear is already there. I don't think another $1.9 trillion at this point is going to make people think that, oh, inflation's going to be 10x what it was before. I don't think that is going into, like, through institutional investors' mindsets. I think they're like, we've already printed so much. If we're going to see inflation, we're going to see it with or without this $1.9 trillion package. Sure, the $1.9 trillion will make things even worse for that inflation argument, but it's not going to make that much of a difference. In other words, I think institutional investors are pricing in inflation happening, but we're not actually anymore pricing in the benefits of a $1.9 trillion package. Less unemployment. That is more people potentially with jobs because people have money to spend. All of this extra spending in the economy, all of this new inflow of mortgage forbearance money, which could go into the stock market, stimulus checks, which could go into the stock market, unemployment checks, which could go into the stock market longer. Now, I'm not suggesting that that's healthy because really we're just transferring money from the government to people and then people are throwing it back in the stock market, which is kind of artificial. It's basically Jerome Powell funneling money directly into the stock market. I'm not saying that that is healthy, but that could be a short-term catalyst at least to get us out of this rut. The stimulus package is expected to pass March 14th. That means we literally potentially have 10 days to go of pain. Now, that doesn't mean that the bottom of the market is in 10 days. See, when we have these recessionary times, markets can actually go down, and then we have like a Monday happen where the market goes up like 10, 15%, and then goes down again, and then goes up again, right? I just think that this volatility period is going to stay probably for at least the next 10 days until this stimulus package, which keeps getting delayed because now they're reading the whole bill because they're freaking morons. Anyway, the longer this gets delayed, the longer we might have to wait. But there is one last catalyst, and this one's a little softer, but it works in mysterious ways, this one, and it's the weekend catalyst, okay? The weekend catalyst says that after a sell-off week, institutional investors go through and they're like, oh, look at all those cheap deals. Remember what I mentioned at the beginning of these catalysts? That there's the potential of institutional investors going, time to move over. Things are cheap. Tesla under 600. That's cheap. Let's go, boys. It is possible that that could happen on Monday, just like what we saw this Monday. Now, will that be followed by more of a crash? Who knows? Who knows? So, bottom line, what the hell am I doing about all of this? And what do I think is actually going to happen? Okay. So this is where we're going now is Magic 8 Ball. Random dude on the internet theorizing about stuff he has very little clue about because I have absolutely no idea what is going to happen with any form of a guarantee. So what I'm about to say is totally just entertainment and speculation. Anyway, now that you're still here, let me give it to you. I personally think that this is the worst. That this right here is potentially the worst week of this crisis. We've been selling off since February 19th. We are now about halfway through that 6-week cycle. I do think, and by this is the worst, I am also already incorporating Friday's pricing. So I think we could have some blood Friday. It would not shock me, though, for us to open dirty and nasty and to rally into the close tomorrow. Complete speculation. Complete speculation. Even if we don't, I think next week, once that weekend effect goes into play, we're going to see some recovery in the stock market. 3-4%. Maybe it'll start slowly. Maybe it'll come quickly, like what we saw on Monday, where all of a sudden it's like, wow, we were bottom and boom, we're up 10-15% again, right? Entirely possible. Not sure. Not sure about that. But I do think that this week could go down as the worst. And that's because next week we're getting closer to that stimulus package. Or Fed Chair Jerome Powell making a decision on those liquidity reserves, which is due before the end of the month. So we have some serious catalysts here. And because we have these catalysts around stimulus and JPOW, it's very likely, in my opinion, that these institutional investors are going to realize we have these catalysts coming. The weekend catalyst comes into play, and potentially the institutional investors go, this is some sweet opportunities over there. Let's go shopping before the stimmy comes. Could be totally wrong. We could literally just go straight off a cliff for the next, who knows? It could be 2 months. I have no idea if these inflation expectations keep going up, right? Again, don't sue me, bro. If you lose money on this, it's not my problem. But what am I doing? I'm putting my money where my mouth is, and in the last 3 days, I've put over $1 million into the stock market. Yes, I'm literally going into more margin to buy right now because I believe what I'm telling you. You don't have to believe me. Call me crazy, leave nasty comments, but I don't really believe that bond yields going to 1.55% is such a freaking catalyst that we're going to see another March 2020. Are you kidding me? March 2020, I went to a grocery store in a hazmat suit because nobody knew what the heck we were up against. That was peak fear. This is a joke compared to that. This is a joke compared to 2008, and that's why Jerome Powell isn't acting. And at some point, the institutional investors will realize this sell-off is a complete joke. Don't talk to me about valuations. Save that for the next video, or my next videos, when I start doing valuation videos on Tesla, Airbnb, Square. Chew me out in those videos. Or do whatever you want, I don't care. All I ask is if you found this helpful, consider sharing the video, and folks, see you tomorrow.